We get calls from people who just have no idea what's going on in their retirement plan, and they know they have to do something, they know they need a change, but they don't know what to do or where to go, and that's why they're calling us.
I think the main draw is the concern to run out of money, and I think they're looking for some type of answer. You're not taking double-digit losses, you don't need double-digit gains. Is an extra 5% really worth risking your whole retirement on? When you remove the emotions, it's an objective situation. It's not opinionated. Here's the money that you have, here's what's at risk, here's your liabilities. Here's the gap. What do we do?
All right, welcome back, everybody. This segment, we're going to talk a little specifically about a few different things and some factors that you guys should be considering during some of these tough times in the market. I do want to remind you guys that this podcast and radio show is for educational purposes only. It is not necessarily investment advice for you, even though some of the people or scenarios might sound like you. You need to call us up and we will meet with you individually, understand everything you got going on, and then we'll make some real recommendations. And if you don't call us, call your financial professional as well too to talk about some of these topics. But Corinne, you made a really kind of a plain question that should be easy to answer, but it really got us stimulated during the break here. Kick us off. What were we talking about just a second ago?
Yeah. So during the break, we were talking about with all of these uncertainties out there, how is it going to affect people's retirement planning in the future?
Yeah, I mean, I think we should start with Ron on this one. What do you do when you're pricing in some ways a bunch of uncertainty? How does the portfolio stay resilient and robust to situations like this?
Yeah, the number one thing that we have to do is to make sure that we're constantly reviewing our positions and our forecasts to make sure we're in the right place. So many times we talked about complacency. People get complacent. They see, prices are going up. My portfolio is going up, so I'm okay. They don't realize just how pushed out of shape it can get because maybe you have one or two stocks that really run away and make it look like the whole portfolio is doing great when it's really not. That's not the story. So you have to be constantly rebalancing a portfolio and making sure that you know what your next steps are going to be. Now, so what we do is, go ahead.
I tend to interrupt Tim usually. I don't usually interrupt Ron. Talking about rebalancing their.
I feel cool now.
I know you're one of the team officially now. I was just thinking when you said rebalancing their portfolio. With a lot of our clients, they pick how much risk they want and they tell you where they stand. So a lot of times you don't even have to get a call from our client saying, hey, I'm worried. You're going based on what they've already sat down and told us. So it's kind of like, cooking something in the oven. You already know when it's going to be done cooking and you're able to make sure you take it out before it burns without having to have somebody else come in. Right?
Yeah, that's a good analogy. We're watching it. We're adjusting the temperature maybe to make sure it's not getting cooked too fast. You don't want that turkey to get too hot, or so it gets dry. You want it to be good. So we're as we're moving through the process, we're watching what's going on, and we're making those adjustments on an ongoing basis. For us, that means every week we're looking at all the portfolios across everything that we have, and saying, okay, how far out of balance is anybody? And usually it's maybe 2%. If the portfolio gets between 2 and 5% out of balance, then we're adjusting it immediately to bring it back into line. And we do that every single week. And we also watch the overall models that we're using. And so we can make adjustments to those at any time that they need to be made to make sure that we're optimally diversified, to make sure that everybody's keeping up with what they need to keep up with. And that's really the key to the question of, what do we do in all these times of uncertainty? We have a plan and we make sure that we're executing the plan and not just sitting around waiting for something to happen to us.
That offers a lot of peace of mind, especially for people like Tim, because you manage our money as well. When he sees things on the news and when he hears things on TikTok and stuff, to know that it's being managed, even if we're on a cruise to Alaska, even if we're
absolutely,
taking the kids to baseball, it's still being looked at. And when you say every week, I know that, we were out there visiting you in Miami and you had just finished going through all the portfolios the like day before we got there, but then something crazy came out and you were like, well, I got to go sit down at the computer for a few hours, because it's not like only on Thursdays. It's as things change. It's really interesting how well we're able to have peace of mind.
Yeah, he's got like a default, right, Ron? And so I think this comes down to, for those listening, these are good factors that you can consider that may be important to you and that we find that are important to us as how we look at the management with our clients. And so rebalancing is what we're talking about. And there's a standard, right, Ron, that you're saying is every week. But to your point, Corinne, if a big event happens or something crashes, you're doing something when?
The day before that, because he's a mind reader.
There you go. But right, yeah.
That's
I
not a
usually
promise
have my
or a
crystal ball
guarantee.
hidden.
Right. But you're saying you're going to do it as soon as you can, right? You're going to start looking at it right away. You're not saying, let's talk about it next week. Let's put it on the back burner.
Exactly. We try to be as absolutely proactive as possible.
So
Sometimes that means we may move a little early sometimes, but that's much better than getting caught
absolutely.
in the wrong side.
So going down this road on this factor that you could consider, which is rebalancing, what's the other side look like if you don't rebalance but once a quarter or every 6 months? Would you then be saying that you're effectively allowing yourself to be exposed to more risk?
I'd argue we also need to include the buy and hold forever people as well, too, if you never rebalance.
Right.
Thoughts on, less frequent rebalancing, Ron? Why don't you rebalance less frequently?
Right.
I imagine you could golf more or take up other hobbies if you didn't. But fundamentally, what makes you say, I want to be this active for these reasons?
Yeah, well, to Tim's point, if you're only doing it once a quarter or once a year, and that's the only time you look at it, there's a lot that can happen in between those rebalancing periods. The beginning of this year, we had a big drop with the tariffs being announced. Well, what if your portfolio manager had rebalanced your account the month before and then let you live through all that without taking any actions whatsoever? Sure, the markets have come back and made that money back. That's not necessarily what's always happened. And the other thing is, you lost out on any opportunity you might have had to take advantage of some other things, such as tax loss harvesting, or maybe grabbing some positions or some securities at a really good discount because they were completely oversold and provided an opportunity. You miss out on all those things by waiting and waiting and waiting. It's really, in my mind, it's just not active management. It's not really taking care of your house.
That's a great point. Was the active word? I think that's the next factor to consider is active management.
Speaking about those people that buy and hold, we had a client who came into us and they had all their money in one company stock. And they were like, I work for this company. I love this company. I trust them. They're never going to be out of here. And so I put all my money in their stocks. And then when we sat down with him and we were looking at what his account value was, we were impressed. We were like, all right, you're doing good. You're all right. But then, as the stock market kept adjusting, we sat down and we said, hey, it's down 3%. Hey, it's going down.
And this is right at the time he was trying to retire. That's the key point. He had zero time horizon. He needed to figure out how to start planning for income.
And I don't remember which one of you walking calculators did this, but you sat down and you said, look,
Oh, it was me.
Your account has dropped X amount of dollars. When you were working, you were making this much per hour. You're going to have to not retire and work another X amount of months or years to make up the money that you've lost just while waiting to decide what you want to do.
No, I remember doing the analysis on that, and it's taken me back.
It was like a Lowe's stock or something.
Hey, I wasn't going to say the company's name.
But so this goes into the concept that Tim likes to talk about also, though, and it's the last retirement paycheck, right?
Right.
And so everything's all fine and good when you're making money. Everybody loves extra volatility when you're working and you can still contribute because you're either going to buy the shares lower, it's going to go higher. You're continuing to work there, so you obviously believe in the company at some level. And heck, at some level, you have some inside information of what's going on in the company. And you're like, oh, we just did this new thing. It'll be a thing in a year or two. And I feel good about that too. So everything's great. But when we couple that with the behavioral decisions that people make in retirement to not spend their money unless they feel uber confident about it, when you retire with a volatile stock, and maybe Lowe's isn't the most volatile stock that's out there, but if you're with a large company with the majority of your funds, you're going to have those apprehensions when there's ups and downs and bumps in the road. So it's about, rebalancing, maybe even diversifying a little bit in situations like that to simply smooth those things out so you can feel more comfortable ultimately.
Well, going back to the diversification or even to the rebalancing, there's nothing to rebalance. There's nothing to protect when you literally have one stock.
Yeah.
So in this example,
cash in one stock.
Right. In this example, he's exposed himself to an exuberant amount of risk, especially when he's starting to have the conversation of, I want to plan for my income as I'm retiring. I know what I'm going to have saved up. I'm not going to have a pension. What should I do? And so I think this gets into active management. Are you looking at things on a regular basis to see if you should or should not change around your portfolio based on what happens in your time horizon and your risk tolerance, with also changes? So even if you're a buy and hold person, eventually you get to a point where your time horizon may change. And now you're going to be focused on a different concept. So this factor that you should look at of active management goes right in line with the rebalancing. So you want someone that's going to look at things more often.
Yeah, that's absolutely a factor you need to consider. Is are you with a team who can make some adjustments on the fly as quick as the market does? And if not, is that important to you? Has anything rung a bell to say, hey, that sounds interesting, maybe I should have a little bit of that? We have a few minutes left, and I don't want to forget about one other thing. It's not quite portfolio rebalancing, Tim, but when we talk about active management, what not everybody knows about you is you are a true subject matter expert in life insurance and annuities. So I'm going to take a quick left turn. Folks, we're going to go out of the market, go to non-market solutions real quick. But when we think about rebalancing relative to life insurance and annuities, I think about the policy review.
Absolutely.
You take a stance on that. So
review.
Give us 2 minutes on policy review.
Real quick, I think policy
management.
reviews are extremely important because cost of insurance changes. Different offers are being made by various annuity companies that could be in your best interest or could not be in your best interest. And that's up to you to find out by digging in and asking your financial advisor who can give you that advice. But with that being said, it could be a good thing if you were to review. You were like, well, I set it and forget it. I was told I didn't have to worry about it. That can be true, but it can also not be true. So it's important to be active in that as well. Take a look at it. Facts to consider are insurance costs does change over time. And so maybe you're in something that had a higher mortality table. Maybe you can get into something that's a lower mortality table when we're talking about insurance. Maybe you can get something more structured in a way that could help you for long-term care if that's become a need. Maybe when you bought that insurance policy, you didn't care about that type of stuff because you were young and weren't worried about it.
Maybe you were a smoker 30 years ago.
That's a great point.
And you bought the policy and now you're a non-smoker.
Excellent, right. So to summon that up, the review is important.
Yeah.
And maybe even talk to your insurance person in a while. I understand, but a financial professional, a financial advisor, a fiduciary can probably conduct that review. They should be able to do so. And so that is what I would say would be another factor to consider are policy reviews because things change. But it's like the old Boy Scout motto, be prepared.
So at the highest level, as we kind of sum up this section for our listeners and viewers here, is that we want you to take a proactive and active engagement in looking at your overall plan. Everything from your budget and expenses to the way that your investments are and when the last time they were tweaked for what's going on in the economy today, to cranking out those old life insurance policies, dusting them off,
pull them out of the cupboard,
pull them out of the cupboard a little bit and take a look at everything. This includes your estate plan. This includes your tax plan, some factors that we haven't even considered. But at times like this, when the market is at near all-time highs, this is when you should really be considering, am I in the best position? There's obviously things that are working well well in the market right now? Do I have enough exposure to that? If something changes in the future, am I in a position to change my exposure levels to be where I need to be? So let's actively manage your financial plan. Let's actively manage your retirement plan. Let's actively review everything that you have in your portfolio. Welcome back, everybody. And I don't know if you were with us for that last segment. I hope you stay with us. And if you're new, you're in for a treat because we are on a roll relative to factors that you should be considering. As you know, we're nearing market all-time highs.
That's the key right there.
And Tim, shot out of a cannon, you're like, we got to talk about tactical. Set us up for what we were talking about on the break.
Yeah, so we were talking about rebalancing that our portfolio manager does, and portfolio managers do. We take a little bit more of an active role, which we talked about next, which is how quickly we respond to things and when we need to do things. And then now what we're talking about and what we want to talk about is tactical. When do you make that move? When do you actually go in and make a short-term adjustment to try to get a net effect? And I think that's important for Ron to kind of open us up with and how you look at tactical management, because you either believe that these strategies will, in the end, net on net, make you more cash on cash return, or you don't, right? Mm-hmm. And what we want you to consider is that if you're someone listening out there or tuning in and you don't believe tactical and active management makes sense, just consider your age. As you get older, things are going to change, life is going to change, and we believe then you may want to reconsider or at least keep your mind open to these types of strategies. So with that said, Ron, can you explain a little bit of how you use tactical strategies in your day-to-day operations?
Right. So let me give a sort of an idea of what I think of when I think of the shift to tactical. Okay. And like you said, really, you have to think about your age. How close are you to retiring? If you're in your 20s, then you have a very long time horizon, and maybe you're not so worried about the tactical side. You say, oh, I'm just going to throw some money in an S&P index fund and let it roll for a while. And think about it this way. That's kind of like you get on a ship on one side of the ocean and you're going to sail up. Your plan is to sail up into the Chesapeake Bay and dock at the port of Baltimore.
Right.
The whole way across the Atlantic Ocean, you're not that worried about hitting something, right? You're just sailing along. So the tactical side, the turns and twists, they're not that important to you. Mm-hmm. But when you get up into the Chesapeake Bay, all of a sudden there's sandbars and there's dangers and there's currents that could get in the way. And the closer you get to the port, at some point that ship stops and they take on a pilot who is trained for those specific waters, and he's the one that lands it all the way.
Very good analogy.
Doing that tactical side.
Absolutely.
Right. So that's how I think about it. And what we seek to do is to always be in the best possible allocation for where we're going, for our destination.
Right.
And so we do that on an ongoing basis, and we're looking at, okay, what moves do we need to make based on what the economy is? And you guys are looking at what moves do we need to make based on where our client is in their stage of life. I was just about
to say, so we share that responsibility on that. Mm-hmm. We look at it from, you're no longer putting money away in your 401k, your IRA, or whatever it may be, alphabet soup. You're going to retire. Hey, maybe we should create an income plan. And we can do it multiple different ways, in the market and out of the market. And your side, Ron, is in the market where you're looking at, well, what can we do with these funds to be more tactical and navigate these new things in retirement?
In a distribution phase, said otherwise.
Right. Yeah, distribution phase, right. Yeah, that's where, when you're ready to retire.
Because the last thing you want to do is get hung up on a sandbar before you get to port, right? So our philosophy is lose less.
Love it.
We want to make sure we're protecting on the downside.
Right.
Because when you lose on the downside, it takes, a 50% loss takes 100% gain just to break even.
So strong, especially when you're not putting money in, right?
Yeah. Yeah.
So that's the whole thing. When you're not adding money to that account, that's what you just said there is so important. And it goes back to what you said, that people get complacent because you get used to this mindset of while you're working, it doesn't really matter. But when you're not, you take that loss, that 50% loss, getting back that 100, that's really hard if you're not adding money in.
Yeah, you're not buying shares down 50%.
That's a very strong statement right there. Absolutely. And then I think that leads us right into another factor that you're also really good at in what you do. You said it earlier, tax harvesting. And so that's a part of tax planning, right? And so a factor to consider is that, or a sandbar, if you will, to watch out for, is how taxes change when you retire. It's different, right? So
Right.
how do you look at that when you're looking at someone's portfolio? You have a retiree, they're retired, they want some in the market, some out of the market, the money in the market, and they're concerned about taxes and they're thinking about, I'm buying these funds and what have you, and I'm concerned about capital gains. How do you address that?
Right. So on my side of it, and this is again one of those things where we both really have to work hand in glove together
Right.
to do this. So on the portfolio management side, what we do is we're constantly reviewing what the position looks like, how much capital gain or loss is in an account. Is it short term? Is it long term? And we try to manage those throughout the year to be as conservative as possible, so that clients don't get hit at the end of the year with this huge capital gains tax bill.
So you're sensitive
We
to
also,
that.
we're very sensitive to that. We also are watching throughout the year. If there's a big pullback, then maybe that's an opportunity for us to do what we call a tax loss harvest. So we sell something that pulled back hard and is now sitting at a loss, and we just exchange that for a like asset, a similar asset, or something that we would want to hold now, and let that move back up. So we get the credit for the loss against any future gains. And so we're protecting and reducing taxes as much as we possibly can on an active basis as we go through those sorts of
That results in
things.
real dollars and cents, doesn't it? I mean, that's real tomato ketchup. That's real money that's being saved as a part of this active and tactical concept.
Well, there's
is
another
this tax planning.
There's one other element. It's very nuanced and it's very high level, so I don't expect anybody on the radio to get it, but it's part about what the pilot of the pilot ship is doing to help you dock, and that's the end of the year phantom capital gains, Ron. It's knowing what's in the portfolio, knowing what's going to be distributed by the fund managers.
Right.
Do you want to give us a real quick high level on capital gains tax distributions at the end of the year?
Sure. So when I worked for a mutual fund management company, we were always looking at what kinds of gains were built up in the fund, because a mutual fund is required by law to distribute capital gains to its shareholders at the end of every year. And so what would happen is you come to the end of the year, you find out you've got a 20% capital gain built up from all the buying and selling that you did. And guess who gets to pay that bill? Not the mutual fund. That gets passed right on to the shareholder. So all of a sudden people get a bill that they were not expecting, that they have to maybe even sell more of their appreciated assets and have additional capital gains in order to pay. What we do is we look at the end of the year, we're watching very carefully, especially through the fourth quarter, and we can monitor which funds we're holding and what their potential capital gains exposure is. And we watch what those dividend dates are so that we can move out of the funds prior to the distribution, assuming that it's going to be more beneficial to do that. And then we can just move into an alternate fund or investment and not have to take that capital gain if we don't want to. It was a really unfortunate situation. Some people buy into a fund right before a capital gain like that gets distributed. And so they end up having to pay maybe a 20% capital gains distribution when they might have actually a loss in the fund because they bought it late in the year. So these things happen, and we do everything we can to avoid that. One little nuance there too, Brian, is that it used to be that you could use exchange traded funds, ETFs, and they wouldn't have those capital gains distributions because they have a much more efficient structure. However, more and more, those are becoming active ETFs. And guess what? That means they're building up those capital gains within those, and they're having to distribute those as well. So we watch all that.
Yep. So folks, if all of that sounded Greek to you and you've never heard your financial advisors talk like that, It's an opportunity for you to give us a call, 757-961-0700. Find us on the web at www.fitzwilliamsfinancial.com. We have a team of advisors and individuals here that are ready, calendars open, ready to sit down, talk with you about what you got going on. We can evaluate you. We can get a second opinion out there. We can do some investment insurance and tax analysis on where things are at. So you can just be prepared and have a plan. And we look forward to meeting with you guys real soon. Again, 757-961-0700 and fitzwilliamsfinancial.com. Take care. We'll see you next time.